In this week's video, we'll leverage the charts to help us answer the question, what is asset class behavior telling us about the stock market's risk-reward profile? To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. Before we review some incredibly informative charts this week, it's helpful to review the legal definition of a fact and the weight of the evidence. A fact is an event that has definitely and actually taken place and is distinguishable from suspicion, innuendo, or supposition. A fact is a truth as opposed to fiction. Weight of the evidence refers to the measure of credible proof on one side of a dispute as compared with the credible proof on the other. It is the probative evidence considered by a judge or jury during a trial. The weight of the evidence is based on the believability or persuasiveness of evidence. And as clients and regular viewers know, the CCM market model uses nothing but facts, hard evidence that we have in hand, and the conclusions are based on the weight of the evidence. So let's shift gears and start looking at the evidence and facts as of July 7th, 2017. This is a weekly chart of the S&P 500 index. These are weekly moving averages that we've used in recent videos. There's nothing particularly magical about them. We chose them for illustrative purposes only to illustrate basic concepts used in the model. This is our full-bore bearish look here with blue, the fastest moving average on the bottom, and the slopes of all of the moving averages are down. After we could see this in the year 2000, it told us the odds had now shifted from favorable to unfavorable, and after this, bad things happened for a long period of time. Similar situation during the peak in calendar year 2007 and early in 2008. We go sideways with somewhat of a consolidation and confused look and eventually flip over to a full-bore bearish look late in calendar year 2007. These are facts that help us understand what it looks like when a long-term trend rolls over from bullish to bearish or favorable to unfavorable. How do the exact same charts or the facts look today? Friday, July 7th, 2017, S&P 500 weekly. We can see the present day chart, and the present day trends don't look anything, not even remotely close to these low probability and concerning looks here or here. Since the concepts will be similar, we'll be able to move more quickly. The peak of the Dow Jones Industrial Average in calendar year 2007, full-bore bearish look, low probability look. The exact same weekly moving averages on Friday, July 7th look like a strong bullish trend that has not yet started to morph into something concerning like this or this. Similar situation for the NASDAQ. We get the bearish moving average crossover and the full-bore bearish look late in calendar year 2007. These are facts. We can measure it, we can see it, we can put it in a model and use it as part of the weight of the evidence. Present day chart on Friday, July 7th has shown a little bit of weakness, but it's really not any different than this weakness here. There's nothing concerning in terms of the facts that we have in hand for tech stocks as of July 7th. Since the financial markets always have been and always will be driven basically by confidence and fear or greed and fear, we can learn a lot by looking at risk-on, risk-off ratios such as SPY relative to TLT or stocks relative to bonds. You can see the trend rolls over. Here the odds favor bonds over stocks. We can see this, and the ratio, the trends peak well before the S&P 500 peaks. This is a yellow flag here in October of 2007. This is a fearful look as the stock market is peaking. You can make an argument that the present day chart is somewhat of the mirror image. This is a bullish trend flipping over to a bearish trend. This is a bearish trend flipping over to a bullish trend. We're all familiar with the concept. The market needs to consolidate its gains. It's extremely important to note during a week that featured concern about North Korea and concern about the Federal Reserve in the United States, stocks, SPY, were outperforming bonds, TLT, for the week by almost 1.5%. That's not what we would expect to see during a period of escalating fear. Well before the stock market peaks in October of 2007, we already have the bearish moving average crossover. This is a full-bore bearish look before the S&P peaks. We don't have anything like that as of July 7th. The moving averages, much like price, have trends that we can discern. This is a downtrend here. This is a series of lower lows and lower highs in the ratio of the S&P 500 relative to the VIX. Notice this ratio starts waving yellow flags early in calendar year 2007 and peaks. The trends in the ratio peak 8 months before the S&P 500 peaks here. Therefore, in the present day, we would be somewhat concerned if we saw something similar in July of 2017. Instead of having an established downtrend against stocks and in favor of the VIX, in the present day, we have an established uptrend in favor of stocks over the VIX. This is a series of higher highs and higher lows in the moving averages for the ratio. This is the textbook definition of a bullish trend, and we also had a bullish breakout from a consolidation period. As you might expect in calendar year 2007, when fear started to pick up, the conviction to own defensive-oriented TLT started to increase relative to the conviction to own small-cap growth stocks, or IWO, in the ETF world. The trends in this ratio started waving yellow flags 3 months before the S&P 500 peak. This is a discernible lower high here relative to this high here. Do we have something similar in the present day? The answer, based on the facts in hand and the weight of the evidence, is a definitive no. We have a full-bore bullish look here with blue on top. The slopes of all of the moving averages on July 7th are positive, and if fear was escalating this week, we wouldn't expect small cap growth to outperform bonds TLT by 1.46%. Growth-oriented banks, the trends peaked 4 months before the S&P 500 peaked. These are yellow flags waving here as stocks are making their final peak in October of 2007. Do we have a similar concerning look today? The answer is no. XLF banks outperformed TLT as of 10:05 a.m. on July 7th for the week by 2.85%. This still looks like a market that needed to consolidate its gains, and this looks like a market that might be coiling for another move higher. Obviously, that is to be determined, and if the facts change, which they may, our interpretation of the facts will change as well. How about the broad stock market? Major peaks can take months to form. We get a lower high here, and then really bad things happen after the full-bore bearish look in our tight moving average cluster here late in calendar year 2007. Based on the facts that we have in hand, indisputable facts, the present-day chart doesn't look anything like this low probability look or even this topping look that we had in calendar year 2007. Obviously, that's subject to change, and that's where the maximum flexibility comes into play. If the market were wildly concerned at this point about the Fed or North Korea, we would expect to see something similar to this peaking look that we saw in the ratio of the S&P 500 relative to gold in calendar year 2007. The trends in the ratio peaked 3 months before the S&P 500 peaked. Are they waving similar yellow flags today? The answer is absolutely positively no. In fact, this looks like a market that needed to consolidate its gains and a market or ratio that is now breaking out in a bullish manner. If markets were extremely concerned about the situation in North Korea as of July 7th, we would expect SPY to be significantly underperforming gold or GLD over the past 5 trading sessions. That's not the case. SPY is beating GLD by almost 2% as of 10:08 a.m. on Friday, July 7th. Obviously, this is subject to change, but we're looking at facts. We're not forecasting. We're not dealing in suspicion, innuendo, or supposition. We're simply looking at the weight of the evidence based on the facts that we have in hand today. How about the ratio of technology stocks, QQQ, relative to gold? We have that bearish rollover look in 2007. The present day chart looks like a strong and sustainable trend in favor of QQQ over GLD. This doesn't look like a fearful market, with QQQ outperforming defensive and Armageddon-related gold by 2.36% over the past 5 trading sessions. Based on the facts that we just reviewed and the weight of the evidence, did we see anything that contradicts the longer-term charts that we've been reviewing over the past 8 to 10 months that tell us to be open to better than expected outcomes? The answer, based on the facts and the weight of the evidence, is no. There's nothing in the charts that we just reviewed as of July 7th that contradicts anything we've covered over the past 8 to 10 months. Obviously, that's subject to change, but the important thing is it hasn't changed yet. And even though we manage based on the facts in front of us, and we'll always manage based on the facts that we have in hand, but the historical comparisons and longer-term conclusions from these past videos are helpful in that we can keep an open mind about better than expected outcomes as well as worse than expected outcomes. Reviewing historical cases that are similar to the present day also helps us with the very, very difficult task of discerning between volatility to ignore within the context of an ongoing uptrend and volatility to respect during the early stages of a new long-term downtrend. You may remember back in March of this year, March 3rd, 2017, we covered some similarities between monthly RSI in this video here. You can find it by Googling this title. There were 3 cases, 1985, 1995, and 2013, that had similar characteristics to 2016 and 2017. Monthly RSI closed above 70 in June of 2017, telling us that the analysis back from March 3rd of 2017 still applies and is alive and well. And you might remember in that analysis, we projected forward in each case 580 trading days to try to help us better understand what type of volatility could we experience in the future, even within the context of a strong and bullish trend. In the 1985 case, there were several pullbacks between point A and point B, which ended up to be a 74% gain. Similar situation, the market's never going to make it easy. There were numerous pullbacks between point A and point B in the 1995 case. The gain between point A and point B was 82%. All bullish trends, including the one in 2013, 2014, have normal and 100% to be expected givebacks within the context of an ongoing bullish trend. To get the 41% gain between point A and point B in this case, you had to withstand a tremendous amount of volatility. To help us better understand what type of volatility might be in store even if good things happen in the future, in these 3 cases between point A and point B, the average pullback was 5.14% on the S&P 500. The median pullback was 4.6%, and 73% of the pullbacks between point A and point B over the 580-day trading period were less than 6%. Moral of the story, patience was rewarded between point A and point B, and understanding volatility was very, very helpful between point A and point B, as it is in every long-term bullish trend, reminding us the importance of not getting too careful about protecting gains between point A and point B. In this March 3rd, 2017 video, we also used all three cases to get some idea of what volatility might look like between February of 2017 and year end. Since RSI is still following that path, that analysis still applies, and it can help us in terms of understanding what type of volatility may occur between now and year end. So the S&P 500 is a daily chart, July 7th, 2017. Let's assume that this is a peak here and we had some type of volatility to ignore within the context of an ongoing trend. How far did the market pull back in the three historical cases that are similar to 2016 and 2017? Said another way, what might volatility to ignore look like in the present day? If we pulled back in a similar manner during the early stages of these three cases here, the S&P 500 could pull back to any one of these colored horizontal lines, including falling all the way back to 2240. In every single historical case, this was volatility to ignore within the context of an ongoing uptrend. Why? Because in every single case historically, the S&P went on to print not only a higher high, but several higher highs after these pullbacks. Like everything we do, this is not a forecast. It's just helping us understand what volatility to ignore might look like between now and year end. We track all of this and convert it into a usable and actionable format in a reasonable amount of time. The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shivako Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.